Hello, I'm Angelo Kourkafas. Welcome to the February edition of Market Compass. Today we'll focus on the state of the US consumer, which has been the strongest cylinder of the US economic engine over the past 12 months. However, there are plenty of headlines about record credit card debt, which raises questions about whether the consumer is tapped out after a post-pandemic spending spree. In our view, the US consumer is not running out of gas, but we do expect a modest slowing ahead. Let's start with why the health of the consumer is very important. To begin with, the US is mostly a service-based economy, largely reliant on domestic spending. Personal consumption accounts for 2/3 of US GDP, and as a result, the consumer is really the backbone of the economy. Therefore, the saying, "As the consumer goes, so goes the economy." And the consumer story has been a positive one so far. Despite high borrowing costs and last year's spike in inflation, the consumer has kept spending at a robust pace, helping keep the economy out of recession. But can that positive momentum continue? According to the New York Fed, Americans have accumulated a record-breaking $1 trillion in credit card debt. We actually crossed that threshold late last year and have kept adding to it since, with credit card balances having grown by 64% since 2003. This record level of credit card debt no doubt is generating some headlines, and just by itself would imply that the consumer is getting tapped out. But thankfully, we don't think that's the case. To use an analogy, the fact that a tree might grow very tall doesn't necessarily imply that it is at a higher risk of falling, because it most likely has deeper roots supporting that height. Similarly, if we look at what's supporting consumer spending, it is not just credit card debt. On the graph, we see household net worth, assets minus liabilities, which has grown 223% since 2003. So the fact that credit card debt is at an all-time high shouldn't be such a surprise. Another way to assess how stretched households are is to look at whether consumers can pay for all of this debt. Debt payments as a percent of disposable income, or what we call the debt service ratio, it is at the low end of its 40-year range. In simple terms, rising incomes are helping support the high levels of debt that we see. But that's not to say that there are no cracks, small cracks, starting to appear. Delinquency rates are on the rise, but from very low levels, as you can see. So for now, we can describe that as normalization, a return to the pre-pandemic conditions. In our view, these are small signs of fatigue, which suggest that spending will slow, most likely, over the course of the year. But the consumer remains in decent shape. Wage gains are supporting incomes and spending. Inflation pressures are receding, and assets like real estate and stocks are appreciating. And all that is contributing to the rise in consumer confidence. On top of that, the labor market remains healthy, with still more job openings than before the pandemic and more openings than the number of people seeking work. With that as a backdrop, let's talk about the economic and market implications. We think the economic expansion will continue, even as a downshift in consumer spending will likely produce more muted growth in the next couple of quarters. But as the consumer slows, areas that have been in decline since last year, like housing and manufacturing, are starting to stabilize and will likely re-accelerate as the Fed pivots to rate cuts in the summer. With the economy likely continuing to chug along and interest rates lower, we see opportunities for investors to rebalance and reinvest some of the cash and CD money in both equities and bonds. Also, we think that segments of the market that have been left behind, like mid and small cap stocks, as well as value-style investments, will start to catch up and leadership will broaden. Despite the really magnificent returns of the Magnificent 7 mega-cap tech companies, we think that diversification is still important, and proper balance has the potential to enhance returns in 2024. For more information on some of the action steps that we discussed in this month's episode, please reach out to your financial advisor. Thank you all for joining us.